Hey traders, welcome back to another episode. Today, I'm going to break down one of the most underrated and surprisingly effective trading strategies, the pivot points trading strategy. This approach is incredibly powerful and works across all major markets, Forex, stocks, commodities, and even crypto. That's because it's rooted in pure price action. And price action stays consistent no matter what asset class you're trading. By the time you finish this video, you'll have a deep understanding of how to use pivot points alongside price structure and the Stochastic Oscillator to enter high-probability trades with confidence. And before we dive in, make sure you smash that like button, subscribe to the channel, and hit the notification bell so you don't miss any of our future trading tutorials. Let's jump right in. So first, what exactly are pivot points? Pivot points are a classic technical indicator that help traders identify key price levels where the market is likely to react, either reversing, bouncing, or accelerating in the same direction. They are calculated based on the previous trading day's high, low, and closing price. From these three values, the indicator projects 7 price levels for the current day. The central pivot point, also known as PP, 3 resistance levels, R1, R2, and R3, and 3 support levels, S1, S2, and S3. Here's the basic logic. If the price is trading above the central pivot point, market sentiment is considered bullish. If it's trading below, it's considered bearish. That simple idea sets the foundation for everything else. These levels act like invisible walls on your chart, areas where price tends to bounce, stall, or break with momentum. And the reason they work so well is that a huge number of traders, from floor traders to hedge funds, are watching and trading from these exact levels. Let's talk about 5 major reasons why day traders absolutely love pivot points. First, pivot points are uniquely designed for day trading. They are calculated from the previous trading day's data and applied to the current day. That means the levels are only relevant for that single day's session. Unlike moving averages or oscillators that lag behind price, pivot points are a leading indicator, giving you potential levels in advance. Second, pivot points work best on shorter time frames, specifically the 15-minute, 30-minute, and 1-hour charts. If you try to use them on the 4-hour or daily chart, the signals become too diluted. But on the intraday chart, they act like a precise roadmap, giving you structure and context throughout the day. Third, they're incredibly accurate. Why? Because of mass psychology. When thousands of traders are watching the same levels and placing orders at those zones, price often reacts, simply because of supply and demand. The more traders watch the levels, the more self-fulfilling they become. Fourth, pivot points give you a rich set of data. With 7 plotted levels, PP, R1, R2, R3, S1, S2, and S3, you have multiple opportunities throughout the day to look for trades, whether you're trend trading, ranging, or catching intraday pullbacks. And fifth, they're super easy to use. Most trading platforms have a built-in pivot point indicator. You don't need to calculate anything manually, just drag and drop the indicator on your chart, and it will automatically plot all the levels for you. In fact, now let's talk about the most popular version, floor traders' pivot points. These are the original pivot points used on the trading floors back in the day. The central pivot point, the PP, is essentially the average of the previous day's high, low, and close. It acts as the fulcrum or balance point between buyers and sellers. Most of the volume during the trading session tends to occur between the pivot point and the nearest support or resistance levels, R1, R1 and S1. This is where a lot of institutional orders are placed. These zones act like magnets for price. As price approaches them, you'll often see reactions, either bounces, consolidations, or clean breakouts. So how do we read these levels? Let's break it down. If the price is above the pivot point, we have a bullish sentiment. In this case, we focus on buy trades, looking for retracements to the pivot or S1 before targeting R1 or R2. If the price is below the pivot point, the sentiment is bearish. We look for sell setups on pullbacks to the pivot or R1 and target S1 or S2. If the price is moving aggressively and breaks past R2 or S2, we might be in a trending day. In rare cases, the price may even test R3 or S3, but these are usually hit only during news events or extreme volatility. Let's now take it a step further and add a second layer of confirmation, the Stochastic Oscillator. We'll use a 14-period stochastic with overbought set at 80 and oversold set at 20. Here's how it helps. When stochastic is below 20 and starting to curve upward, it signals bullish momentum, great for long entries. When stochastic is above 80 and starting to curve downward, it indicates potential bearish momentum, ideal for short entries. The oscillator is key for timing your trades. Pivot points give you structure and stochastic gives you momentum confirmation. Now let's go over the complete rules for a buy trade using this strategy. Step 1. Open a 1-hour chart on your favorite trading pair, whether it's a Forex pair, stock, or crypto. Step 2. Add the pivot point indicator and the 14-period stochastic oscillator. 3. Check the relationship between today's pivot point and yesterday's. If today's pivot point is higher than yesterday's, it signals bullish momentum. It's our first filter. We only want to trade in the direction of the current trend. Step 4. Wait for price to pull back to either the central pivot point or S1. Step 5. Check the stochastic. If it's below 20 and beginning to curve upward, you've got confirmation. Step 6. Enter a long trade. Set your stop loss just below the recent swing low. Your first take profit target is R1. If momentum is strong, you can trail your stop and aim for R2. Now let's go over the sell trade. Same setup. 1-hour chart, pivot points, stochastic oscillator. This time we want today's pivot point to be lower than yesterday's. That gives us a bearish bias. Wait for the price to rise up into the central pivot or R1 zone. If stochastic is above 80 and curving down, it's time to consider a short. Enter the trade. Place your stop just above the recent high. First target S1. If the move continues, aim for S2. Let me give you some pro tips to get even better results. First, avoid trading when pivot levels are bunched close together. That usually means the market is in a consolidation or range. You'll likely see choppy price action and false breakouts. Better to wait for cleaner setups. Second, focus primarily on the central pivot, R1 and S1. These are the levels that get tested most frequently. R2 and S2 are used in trending markets. R3 and S3 are rarely hit. Those for high-impact news days or big trending moves. Third, this is a trend-following strategy. Don't try to trade reversals at S2 or R2. You'll get chopped up. Stick with the dominant direction and use the oscillator to help you time entries with momentum. Pair this with solid risk management. Risk no more than 1% to 2% of your capital per trade. Your stop loss and take profit should always be clearly defined, and you should know what invalidates the setup before you even enter the trade. Fifth, backtest this strategy. Pull up charts from the last 30 days. Apply the pivot levels in stochastic, and study how price behaves around the levels. This will train your eye to spot high-probability setups quickly in real time. Let's now look at a few chart examples so you can visualize how this works. Here's a long setup. Price opens above the pivot point. It retraces to S1. The stochastic is oversold and curling upward. We enter long, place our stop below the low, and target R1. Clean bounce, clean exit, and solid reward to risk. Here's a short example. Price opens below the pivot. It pulls back to R1. The stochastic is overbought and turning down. We enter short, place our stop above the swing high, and target S1. Again, clean move, all based on logic, structure, and momentum. When you combine pivot points with the stochastic oscillator and follow the trend, your edge improves dramatically. And that's the complete breakdown of the pivot points trading strategy. It's simple, logical, and incredibly effective when applied with. If you found value in this breakdown, please like this video, subscribe to the channel, and share it with your trading community. Whether that's on WhatsApp, Facebook, Discord, or Twitter. Thanks for watching. Trade smart, manage your risk, and I'll see you in the next one.